Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have John Rubino with me once again. John's been a guest on this show many times in the past. For those of you who may not know him, he hosts a website, dollarcollapse.com, and he is the co-author with James Turk, co-authored the book Gold, that is the Money Bubble, What to Do Before It Pops. And John has really published and written a number of other books. He also writes for the CFA magazine. Welcome, John. Good to have you with me again.
Hey, Jay. Good to be back.
Always good to talk to you, John. Before we get started, I have to ask you, take a minute or two, perhaps, and tell us a little bit about an article you're working on now for the CFA, the Certified Financial Analyst magazine. Really fascinating. You were telling me about it yesterday, having to do with artificial intelligence. Could you just explain a little bit about that to our listeners?
Well, yeah, it's about the automation of the money management business. Now, automation has been around forever, since the cotton gin and factory robots started putting working class people out of work. But now it's moving up the economic ladder because of two things. One is called big data, which is our newfound ability to aggregate incredible amounts of information and manage it. And the other is artificial intelligence, which is the ability to look at this stuff and mine it and sort through it and find patterns that can be useful for lots of different things. And one of the things it's useful for is money management. You can use an artificial intelligence now to, let's say oil goes up $10 a barrel. You can look back throughout financial history at 1,000 different variables that were affected by changes in the oil price and come up with a series of actionable predictions about what should happen if oil goes up. And that's the kind of thing that, a junior analyst at a hedge fund used to spend a career trying to figure out, and it took a really long time. And you couldn't do it in real time. If oil went up suddenly, you couldn't do that calculation and have it ready for your boss that afternoon. Well, new services that are coming online now can do that. And so, in effect, they're putting a lot of lower-level finance people out of work. And it's only going to get more extreme from here because AIs and big data and the technologies that combine the two and create useful products are just in their infancy. So let this thing run for another 10 years, and who knows what happens. It could be that the vast majority of investing is done either passively via ETFs and things like that, or automatically via black box trading systems, and that there's not a whole lot of room left for finance people. And, suddenly, for symbol manipulators, automation and the risk of being just made obsolete by technology are real. And that's a huge change that's coming that we're not really accounting for. When we talk about financial crises and things like that, we're talking about the world as it is, borrowing too much money. But this is a story of the world changing in ways that really dovetail and amplify the effects of a financial crisis. Because, people could be being thrown out of work because of artificial intelligence. At the same time, they're being thrown out of work because of a financial crisis. So this could be a kind of a perfect storm coming up for people in a lot of different industries where, you lose your job because your company gets into trouble, but your job never comes back because you've been replaced by...
So this is a bit disturbing, I must say. Now, your article is going to come out. When will it be published?
Probably in the fall. The way magazine articles work is there's a long lead time between handing something in and it actually appearing. So I'm guessing September, something like that. The story will not have changed in the meantime, though. No.
Well, I hope not. It's a little disconcerting, to say the least, because I'm just wondering, a tremendous number of people, especially in New York City and, in the coastal areas, in the financial sector, an awful lot of unemployed people then possibly in the future.
This is kind of a story of Silicon Valley aiming an arrow at the heart of Wall Street. Because basically they call them Fintech, for financial technology companies, are being funded by Silicon Valley venture capitalists. So Google, Facebook, people like that are building divisions that do a lot of this stuff, and then the VCs in Silicon Valley are funding startups that do a lot of this. And so it's kind of a clash of cultures here, because it's arguably the two most powerful cohorts of symbol manipulators in the world, and one of them is threatening the livelihood of the other.
I just wonder what's going to happen. I mean, people become superfluous, right? And then what do? You put them out to pasture, essentially.
Superfluous. But the lower level work in a field like finance will be automated. And what will be left is the really high level stuff. You know, the Warren Buffetts of the world, who don't operate with spreadsheets and stuff like that. They operate by intuition, where, who could have known 30 years ago that Coca-Cola was going to be the biggest drink brand in the world for the succeeding 30 years? Warren Buffett somehow did. So these intuitive leaps are going to be even more valuable in the future, and the people who can make them, the George Soroses of the world and the Warren Buffetts, will be even more in demand and more successful. But the average analyst who does grunt work niche going forward. So you create even more of a superstar economy in this scenario, where it's the vast majority of the wealth flows to a handful of people who are just brilliant, the LeBron Jameses of the finance world. And there isn't a whole lot left for the people who are further down the ladder. And so they're kind of, they're not well paid to the extent that they have jobs at all. And the guys running the show there are a handful of them to begin with only, and then they make incredible amounts of money, and then they work primarily with artificial intelligences. So, it's a very different world from the teeming kind of Wall Street that we have now, where you've got literally hundreds of thousands of people working below them. Well, those hundreds of thousands of people are at risk from the technological changes that are happening now and that are going to accelerate in the not-too-distant future.
Wow. Well, I mean, this is a story that we'll probably want to talk to you about some more, perhaps after the article comes out, definitely. I mean, what's the time scale on this? I mean, how much time do we have? I mean, this is something that's moving very rapidly, I think.
Well, that's the thing. We don't think in terms of exponential change. We, as humans, think in terms of linear change. We extrapolate, but exponential change catches us off guard.
Yeah.
And so this might be an example of exponential change, where this stuff is just, it's hitting a critical point where it can actually do the things we're talking about. And then there's no reason why everybody shouldn't have AI capability if that's what it takes to succeed in the business. So you've got services. There's something called Kensho, which you see on CNBC now. They'll have a line that says Kensho analysis of this. And Kensho is not a person. It's not Goldman Sachs's technical analyst or anything. It's an AI that somebody created that does what I talked about before, looks back throughout financial history to see what happened in the past when this thing that's happening today happened before, and comes up with 10 actionable trade ideas, boom, and does so instantly. And that's just, version 1.0 of these capabilities. Right. So let this stuff progress exponentially for another decade, and God, the world will be so different that it's impossible to predict right now. All
right. Well, it's an ongoing story, but talking about things that are more apropos to this point in time. You've written a couple of articles that really caught my eye. The Unintended Consequences of Easy Money, Part 1 and Part 2. Easy Money, Part 1, Overcapacity equals deflation. Explain, if you would, John, what are the connecting points? How does that work?
Well, the idea of easy money is basically to create inflation, right? You push interest rates down, you run big deficits, you create a lot of new currency. And the idea is that makes the currency get less valuable and prices go up, and it lessens the burden of your debt because you're paying back your currency you're paying back your debt in cheaper currency. Mm-hmm. Well, the real effect of this is the opposite, because what happens when you lower interest rates and pump out a lot of new currency is that sends a signal to the market to build new factories and to buy more stuff. And so what happened in the last few decades is that by pushing interest rates down in order to cheapen our currencies, we encouraged most of the world to build vast overcapacity in a lot of industries. China quadrupled its debt in the last 6 years and used a lot of that money to build massive, for instance, steel-making capacity. They went from like 10% of the world's steel-making capacity to 40% in the space of half a decade. And they produced more cement in 3 years than the U.S. has produced in the last century. So this massive overcapacity in these basic industries leads to price cuts, right? Because China is flooding the world with steel and cement and lots of other things. And that's either putting out of business their counterparts in other countries or forcing them to cut their prices in order to compete. And so that's deflationary. So what you get with easy money is deflation, because easy money distorts the pricing signals in the market and leads to overcapacity. And that's what we're seeing around the world. So it's canceling out the impact of, quantitative easing here, and Abenomics in Japan, and all the crazy stuff they're doing in Europe to try to cheapen their currencies. Because when, for instance, the price of steel goes down, that's the same thing as saying the value of the dollar and the euro and the yen are going up relative to this crucial basic material. And so the more we do this, and we're going to continue to do it apparently, the more deflation we're going to end up with. So we'll see inflation in certain areas, in other words, rising prices, but we'll see deflation that offsets the inflation in lots of other areas, and so it's not working. And so the big takeaway from this is that the stuff we're trying to do to save ourselves from our past mistakes is failing. And
not only, I was going to say, John, not only is it not working, it's failing, is it's actually bringing more of what they're trying to get away from. It's bringing more of it about, it would seem to me. And let me ask you, because it seems to me that, if you were simply printing money, literally printing money without any offsetting debt or on the balance sheet, you could create inflation, could you not? You would create it. Let's say that you just showered with literal helicopter money without any offsetting debt on the books of the economic system.
You would think. Well, to the extent that the amount of money that you're creating and throwing out into the market grows faster than the productive capacity that people will produce because they're fooled into thinking it's a good idea, then you'll have inflation. But the secondary effect is that, that productive capacity is going to come online eventually. And so that's, this is malinvestment that you're creating on a gargantuan scale that has to blow up on you out there in the future, because that's the nature of malinvestment. If you build something that you shouldn't have built, then it costs you money rather than makes you money. And so, you could generate, we could devalue all the currencies of the world instantly if we wanted to, just by passing a law that says from now on, this is our exchange rate.
All right.
But the secondary and tertiary effects would end up canceling out the, whatever benefits you get from devaluing your currency. Mm-hmm. So, my point in writing these articles is to propose the idea that you can't do it this way. You cannot inflate your way out of a massive amount of debt in a fairly free market system, because the entrepreneurs who are making decisions about a capital allocation will act in ways that cancel out your attempts to get yourself out from under your debt. Because remember, easy money leads people to borrow money, right? Because you're saying, whoa, money's on sale, borrow some, spend it. Right. So that increases the amount of debt in the system. So if you're trying to manage a debt load by devaluing your currency, but what you do ends up creating more debt, then you're not out from under it at all. And that's really what we've got here. Debt keeps going up, despite the attempts to get rid of it.
Yeah, not only does debt go up, John, but if I look at it, it's going up almost exponentially compared to income, if it's growing at all. If you believe real GDP is positive, and there are questions about that. I think in the U.S. it's very close to not being positive. But anyway, over the long term here, we see sort of almost a linear growth in income, and if you look at the same, so the growth of debt is growing very, very rapidly, much more rapidly than income, right?
Oh, yeah. See, you reach a point when there's so much malinvestment out there that whatever else you build, if you build a new steel plant right now, is that going to make you any money? No, it's not. And so it's not going to allow you to pay off your debt. So that debt's still going to be there. So something called the marginal productivity of debt goes down. In other words, the amount of new wealth you get when you borrow money and invest it, in a healthy society should be about 1-to-1. You should borrow some money and you should generate at least the cash flow to pay off that debt.
Sure.
Right? And that's the way it was in the 60s and 70s in the U.S. But now it's been going down and down and down until, by some measures, it's zero now. In other words, we can borrow infinite amounts of money and get zero real GDP growth going forward. And so that's kind of the end of the road. If we really have hit zero for marginal productivity of debt, then that's the end of this game. It's over, and we have the mother of all financial crises staring us in the face. And I don't know if this is the end, but based on that chart, we're certainly close to zero.
Well, John, all the countries are doing the same thing, the same monetary policy, the same Keynesian monetary policy that suggests governments should deficit spend and print money to pay for it. You don't have to really save money to form capital. You can just create it out of nothing. I mean, it really bugs me when I think about, they say we recapitalized the banks. How did you recapitalize the banks? Well, they did it in a couple of different ways after 2008. They pushed interest rates down and basically stole from savers. And they, of course, created money out of thin air and gave it to the banks, essentially. And they call the banks are recapitalized now. They're strong and they're recapitalized supposedly. It's just horrible what we're doing. But you mentioned steel, and part two, easy money over capacity equals trade war, as you say. Talk to us a little bit about what's happening. The U.S. just recently hiked its tariffs on Chinese steel, I guess, right?
Yeah, when China was building this massive, globally dominant steelmaking capacity, they didn't really go around and ask anybody else whether that was a problem, the other countries who have steel plants. And it turns out it is a problem, because if China was able just to produce all the steel it can and then sell the excess to the rest of the world, they put us out of business in steel. And so in the U.S., that's a political loser, right? To allow a big industry like that to go out of business just to placate some trading partners. So, we've responded the way most countries would normally respond. We slapped a massive tariff on imported Chinese steel to protect our domestic industry. And Europe just announced they're going to do the same thing to protect their indigenous steel industry. So that's another sign or another example of unintended consequences that defeat the purpose of some misguided policy. China thought they would become a powerhouse in steel and dominate the world. Well, nobody else wants their steel now. So they're going to be stuck with plants that make 50% more steel than Chinese industry needs domestically, or so, And what are they going to do with it? It's not clear. They could dump it in the remaining countries that'll still take it at a huge discount and lose money on each unit. Or they could close down a bunch of the steel plants that they built in recent years and just write off the investment. But either way, it turns out it was a bad deal, what they did. Borrowing all that money and then spending it this way was a mistake. So they're going to be stuck with the debt. It's not going to go away. But the income-producing assets are going to disappear one way or another. Either they'll stop making money or they'll just be closed down. And so these trade wars that result from overcapacity are really debilitating for the global economy, because somebody is hurt by that. We in the U.S. have to pay more for steel. China can't sell its steel. And so consumers here have less free cash, and producers over there have less free cash. And so the economy in general across the globe is weaker than it would have been if we would had just kept interest rates at reasonable levels that sent clear signals to producers who then borrowed money only for productive uses. If we'd done it the way we did it in the 50s and 60s and 70s, things would be much better than they are, and we wouldn't be staring at this gigantic crisis. So,
yeah, of course, it seems to me, John, this is exactly what happened in the 1930s. And currency wars, essentially countries trying to devalue their currency and then putting on tariffs and so forth. It's very frightening, it seems to me. I mean, how in terms of relationships between nations, this is not a good direction to go either. This pretends possibilities of international conflicts more and more, I'm afraid.
Oh yeah, well, trade wars are the first step because you make each other mad, right? And so you're less likely to cut each other slack when there's some kind of a conflict out there that you could have sat down and settled if you were on good terms in other ways, but now you're mad already. So, you go to that conference room already not willing to give up anymore because you perceive that this other guy hurt you in some way.
All right, John, with just my engineer's telling me we have less than a minute left. I wanted to ask you about what's going on here with these $100 million homes. 30 seconds, tell us what's happening. This is another example, I guess, of malinvestment and what happens, right?
Yeah, it really is, because easy money led the 1% to worry about the value of their cash, so they stashed it in high-end assets, trophy real estate and yachts and corporate jets and things like that. And now they've kind of run out of steam, and you're seeing $100 million homes pile up around the world, and Miami condos are in glut, and the price of corporate jets is plunging, and all of this is a sign that we've reached the limit to induce rich people to keep on buying insanely useless baubles, like $100 million houses.
All right, we're going to have to let it go at that, John. We're out of time. Love to have you back again sometime very soon. So thank you very much for being with us.